Welcome everyone to today's webinar where we're going to look at Division 296. We've got a few attendees still signing in. We'll give it a minute or so while they come in. If I'm coming through clearly, could you please type into the Q&A window that the sound is coming through fine? All right, cool. So we'll get started, given that we've got a few that's already dialed in. Welcome everyone to today's webinar on Division 296. My name is Anthony Fernandez. I'm one of the product managers in the Simple Fund 360 team. Before we kick off the session, just some housekeeping matters. This webinar is being recorded, and all those who've registered for this webinar will receive a link to the recording along with the slides. At any point, if you do have any questions, please type it into the Q&A window. We've got quite a number of attendees for today, so we've got a few colleagues dialed in just to help out as well. But we will take any remaining questions at the end and answer them for you as well. Joining me today is Lynn Formica, who is the head of education at Heffron. So she'll be covering off I guess, the technical portion of today's webinar, which is pretty much the heavy lifting. I'll be just here sort of moderating today's webinar, and I'll at the end go through what sort of Simple Fund's looking to implement as part of the whole Division 296 legislation. So over to you, Lynn. I'm gonna hand over controls. Let me stop sharing my screen. And Lynn, you should be able to share your screen now.
Beautiful. Thank you. It's coming through.
And yep,
Excellent.
and I'll hand over to you.
Wonderful.
Thank you.
Thank you. Thank you, Anthony, and thank you for inviting me to present on Div 296 tax. It's taken us a few years to get here, but we finally have a legislated Div 296 tax. So certainly time that we're all getting ourselves familiar with the concepts and what our clients might be thinking of doing. So,
Absolutely.
yeah. So we have Sean Johnston from Heffron who's looking after the questions box while I'm talking. So feel free to pop your questions into to the Q&A and he'll do his best to answer those. But I've got a section for questions at the end as well. So just as a reminder or a refresher, what is Div 296 tax? So remember, it's a brand new tax for individuals with superannuation balances in excess of a $3 million threshold. It's a personal tax. So it's levied on the member, not the superannuation fund. The member will, of course, have the choice to pay that tax personally or release monies from superannuation via a release authority, like we do with Div 293 tax. It starts the 1st of July 2026. It is well and truly legislated, so there's no going back now. And the first year end is going to be the 30th of June 2027. Some clients will, of course, choose to withdraw some of their superannuation benefits in excess of the legislation coming in. Just remember that all the usual conditions of release rules apply. So your client needs to make sure they've met a condition of release before they're eligible to access some of their superannuation. So reached age 65 or retired, reached their preservation age and retired, for example. If you're 45 years old and you're in the unfortunate position of having, say, $5 million in super, unless there's something special going on about your circumstances, you're just stuck with the tax. You're not going to be able to withdraw some of your superannuation to get yourself down under the threshold, unfortunately. So how do we calculate the tax? So the first year in, as I said, is 26-27. So for each financial year from 26-27 onwards, we use this formula. And this formula, if you've been following along with Div 296 tax, it's the same formula that we've always had, just the elements in it are slightly different. So we've got our 15% Div 296 tax rate. We times that by proportion of our superannuation balance in excess of the $3 million threshold, and we times that by Div 296 earnings. And I'm going to explain what Div 296 earnings are. What's different about this formula is that we now have the second row. So we also, in addition to having a $3 million threshold, we've got a $10 million threshold. So we've got an extra 10% Div 296 tax payable for those people whose proportion of their super exceeds that $10 million threshold. Just in simplistic terms, if I had someone with, say, a $4 million superannuation balance, so they've got $1 million in excess of the $3 million threshold, so 25% of their $4 million balance is in excess of the threshold. For them, their Div 296 tax is going to be 15% times 25% times whatever their Div 296 earnings is going to be. So just conceptually, for someone who had, say, $9 million in super, they're going to pay their normal fund tax on all of their earnings across all of their balance. And the fund tax, remember, is up to 15%. I say up to 15% because many people who are in Div 296 territory will be in pension phase. So they're not paying fund tax on their pension balances. They'll also then, if they've got $9 million, they'll also then have the 15% Div 296 tax applied to a portion of their earnings in excess of the $3 million threshold. So conceptually, we've got a portion of their superannuation earnings being taxed at up to the 30%. No one's going to pay the 30%. As I said, a lot of people aren't paying the 15% tax because they're in pension phase in the first place. If it's someone with $15 million in super, then again, they're paying their normal up to 15% fund tax on the earnings across their entire balance. They'll then have an extra 15% Div 296 tax based on their earnings that are attributable to the balance in excess of 3 million, and then another 10% tax attributable to their earnings in excess of the $10 million threshold. So for them, it's a threshold or a headline rate of earnings at up to the 40%. But of course, just a portion of their super earnings is being taxed at the 40%. So if we've got, your client's Div 296 tax bill is going to be based on the size of their superannuation balance in comparison to that 3 million and that $10 million threshold. What do we actually include in total superannuation balance? So not a lot is changing there. So for most people, it's just what they have in super. So it's the value of their superannuation interests that have account balances. So their normal accumulation account, account-based pensions, even market-linked pensions, we just take the value of that particular pension. No changes happening there. We also include the value of our superannuation interests, which don't have account balances, so our defined benefits, whether they're in accumulation phase or they're in pension phase. Now, there are going to be some changes to the way that we value those pensions, but they're not starting until 30 June 2027, so we can put those to the side for the moment. The other thing to remember, just like any time we're using total superannuation balance, it's all the superannuation that's in my name. So if I've inherited super in the form of a pension, then it's going to be accounted towards my total superannuation balance. And it's from the moment, it's included in my total superannuation balance from the moment I become entitled to that pension. So if it's a reversionary pension, it happens automatically on date of death. There's no 12-month delay like there is for the purposes of the transfer balance cap rules. For total superannuation balance, the pension reverts to me and it's immediately included in my total superannuation balance. Now, the government is making a slight change to the total superannuation balance definition, but it's only for Div 296 purposes. So we're effectively going to have two different definitions of total superannuation balance, one for our normal calculations, contribution cap thresholds, those sorts of things, and one for Div 296 tax. And the only difference is that for Div 296 purposes, we're not going to have that add back, that crazy add back that we do for some LRBA loan balances. So what total superannuation balance do we use to work out what our proportions are? So when is our total superannuation balance relevant? So we have some transitional rules for the first year. So for the first year only, so for 26-27, we have a single test time, and that's 30 June 2027. So if we've got a member who's got less than $3 million at 30 June 2027, they're not going to have any Div 296 tax payable for 26-27 because they're under the threshold. So even if they start the year with a much higher balance and they withdraw some of their superannuation, none of those withdrawals get added back. It's purely what their balance is on 30 June 2027, which determines whether they will pay Div 296 tax for that 26-27 year. But that's only a transitional rule for the first year. For future years, so for 27-28 and onwards, we're actually going to have two test times. So we have to look at someone's balance at the start of the year and the end of the year, and we count the higher of the two. So it's essentially a rule which is designed, they call it an integrity rule. So it's designed to make sure that we're not skipping out on Div 296 tax by being able to take monies out of super before the end of the year. So if I've got a total superannuation balance of in excess of 3 at the start of the year or the end of the year, I'm going to pay Div 296 tax. So if we look at an example of Lainey, she's got a superannuation balance of $12 million on 30 June 27. Let's say she takes out $5 million, 15th of July 27. So very early in the financial year. And then we get to 30 June 2028 and her super balance is 7.2. So opening balance, so we look at what was the balance at the immediately preceding year. 30 June 27, it was 12. Her balance at 30 June 28 is 7.2. When we are working out her Div 296 tax liability for 27-28, we actually have to base that on $12 million, the higher of the two, whatever was the higher of the opening balance and the closing balance, which is a bit unfortunate, and we'll have some flow-on consequences of that in terms of people who have, unfortunate situations where their superannuation balance might disappear from fraud or those sorts of bits and pieces, but this is the rule that we have. So critically, what's in our Div 296 earnings? So, as I said, we're paying tax on, we've got that tax rate, we've got our proportion. The critical aspect is what's actually included in Div 296 earnings. So we actually calculate that on a fund by fund basis. So our first step is to work out what the fund's Div 296 earnings are. We're going to use normal tax concepts for that, certainly for us as our starting point anyway. And for self-managed super funds and large funds, they'll do that the same. There's some special rules for defined benefit funds, but we're not going to go through those today. Once we've calculated the fund's earnings, we then have to share that out, attribute it to each of the members of the superannuation fund. And of course, the method of doing that is going to be very different between self-managed super funds and large funds. Once we've worked out what the members' share of the earnings are, we call that relevant superannuation earnings. So the members' share of the fund's Div 296 earnings is going to be called their relevant superannuation earnings. And that's the figure that we're going to be reporting to the ATO, so the ATO can work out what our client's Div 296 tax liability is. So how do we calculate the fund's Div 296 earnings? So as I said, our starting point is the fund's tax calculations. So if we think about our fund's taxable income, we know that we include realised capital gains after discounting, of course, and net of any capital losses that we might have made in the year or carried forward from previous years. We include dividends, distributions, interest, rent, all of that investment income that we get, franking credits, of course, and assessable superannuation contributions. So our concessional contributions, we include those in and we pay the 15% tax. But we don't include, or we get an exemption for our pension income. If we're paying pensions, anything other than a transition to retirement income stream, we get exempt income. So from the fund's tax calculation, we get to take that off, and we get to take off our tax deductions. But of course, excluding any of those that were attributable to earning our exempt income. Now, there are no changes to how we're going to calculate the fund's tax calculations. All the stuff that I'm about to talk about is purely for the purposes of working out our Div 296 earnings. So from the fund's point of view, normal tax rules will continue to tax our investment income on a cash basis. So most income is going to be taxed on receipt. Distributions is the odd one because they're taxable in the year to which they relate. So from the point of view of Div 296 earnings, as I said, the starting point is the tax calculation. So again, we'll include our realised capital gains in there, net of losses, taking off our discounts, but we have some special rules because we're allowed a cost-based adjustment, which I'll talk us through. Otherwise, though, we keep adding in our dividends, our distributions, our rent, our franking credits as normal. But we don't include superannuation contributions in Div 296 earnings. That's capital, really, so we shouldn't be paying extra tax on that. In a quirky fate, we add back exempt income. So if we've got pension funds, for Div 296 purposes, it's as if the fund had never been paying pensions. So we add back ECPI. So if we look at an example, let's say we've got a fund, single member fund, $4 million in the fund, all being used to pay an account-based pension. You might be thinking, how on earth could I have $4 million in pension phase? Well, let's say the person had, when they first started their pension, they were under the transfer balance cap and they've had great earnings since then. So that's why they're allowed to have $4 million in pension phase. And let's say that fund earns $500,000 worth of rent in a particular year. For the fund's tax calculation, we would know that that whole 500 grand would be exempt income. We wouldn't pay any tax on that. But from the point of view of the fund's DIV 296 earnings calculations, we have 500 grand of rent included in our earnings calculation because we ignore the fact that we're in pension phase. So once we've calculated our DIV 296 fund earnings, we have to share it across the members. And as I said, the sharing way we do it is going to be different between self-managed super funds and large APRA-regulated funds, our industry funds, our retail funds, those sorts of things. From a self-managed superannuation fund point of view, we're going to share it out based on a weighted average of the members' balances. We're typically speaking are going to get an actuarial certificate to do that. If I had a single member fund, not likely that I'm going to need an actuarial certificate because it's quite obvious that 100% of those earnings belong to that single member. But otherwise, generally speaking, an actuarial certificate would be required. Now, we're only going to need to get that actuarial certificate for superannuation funds that have in-scope members. So members who have in excess of the $3 million, either in the self-managed superannuation fund or in combination with the balances they have in other funds, because remember, we're dealing with a total superannuation balance calculation. So the actuary is going to work out that average weighted member balances for us in a very similar way that we do for our ECPI calculations when we get an actuarial certificate for our pension funds. So our pension funds already get an actuarial certificate. This will be an extra page to the certificate with the DIV 296 calculations. If we've got an accumulation fund that happens to have an in-scope member, then they're going to be needing an actuarial certificate even though they haven't needed one before. You might also have some superannuation funds that have member-specific assets. So we've got an asset that we've tagged as belonging to a specific member's account. So maybe we've had a property transferred in under a New South Wales stamp duty exemption or something like that. For the point of view of calculating the fund's actual earnings, then of course we only give the earnings to the earnings relating to that particular asset to the member that asset is tagged to. That all goes out the window when we're calculating DIV 296 earnings. Essentially, we ignore any of those specific asset allocations. It's just like a pooled asset from the point of view of DIV 296 earnings. Actual fund earnings still get distributed the way we always normally would. This is just a special calculation, a special attribution when we're trying to work out the share of the DIV 296 earnings amongst the members. APRA funds, as I said, do it completely differently. So they'll come up with a fair and reasonable method that'll depend on their fund. So it'll depend on the investment options that are offered, asset allocations, those sorts of things. Again, the key is consistency and making sure that it's fair and reasonable to all of the members. Again, defined benefit interests, we do those in quite a different way, so we're not going to cover those today. So if we just have a bit of an example of a self-managed superannuation fund, let's say it is Fred and Mary. So we've worked out the average balance of this fund for the year was $10 million, and $4 million of it belonged to Fred, and $6 million of it belonged to Mary. So from a proportioning and attribution basis, 40% of the earnings belongs to Fred, and 60% of the earnings belong to Mary. And let's say our DIV 296 earnings for the fund is $500,000. So we give 40% of that to Fred, 60% to Mary. So Fred's share of the fund's DIV 296 earnings is $200,000. So that's his relevant superannuation earnings from the self-managed superannuation fund. Fred may have interests in other superannuation funds. If he does, then he'll have relevant superannuation earnings from those funds as well. And essentially the ATO is going to add them all together to work out Fred's total earnings for Div 296 purposes. So we only have to look at what the fund's position is. We give that information to the ATO, and the ATO is going to then work out what this Fred's Div 296 bill is in total, calculate the bill, and send that off to Fred or Fred's tax agent. And just a note in relation to that earnings that we're sharing out. So we've just shared that 40-60 split based on the time that Fred's balance was in the fund and the size of his balance. But we don't actually take into account when the earnings were realised. So this can lead to some quirky results happening. So if we think about an example, let's say at the start of the year, Fred was the only member of that superannuation fund. And when he was the only member of the fund made a really big capital gain, sold an asset and made a big capital gain. From the point of view of the fund's actual earnings allocation, Fred would get all of that capital gain because Mary's not a member of the fund yet. Mary joins the fund, and then she brings in a sizable balance, and we end up with those average weighted balances of 4 and 6 based on the time that Mary's been in the fund, for example. Now, I said that big capital gain that was crystallised, it was earned by the fund, whilst Fred was the only member. For the fund's actual earnings allocation, he'd get all of that capital gain. When we're divvying up our Div 296 earnings, which will include that capital gain, Mary's going to get a share of it. Even though she was not a member of the fund at the time the earnings were realised, doesn't matter because this particular calculation that we do to attribute the earnings across the members doesn't take into account when we sold the particular asset, when the rent came in, when the distribution was earned. It's just based on the time that they're in the fund and their balance at that particular time. So we're going to end up with some quite quirky results when people are joining and exiting superannuation funds. So I said that realised capital gains are included in our Div 296 earnings, but I also said there's going to be some special adjustments. Now, those special adjustments are there to protect capital growth that has accrued prior to the 30th of June 2026. Because Div 296 tax is about calculating future earnings. So if we didn't have this special adjustment in play, then when I realised an asset in July 26, I'd be paying tax on growth that had accumulated in prior years. So to stop that happening, there's a special CGT adjustment that's going to happen. Now, that adjustment is going to be worked out differently for self-managed super funds versus APRA-regulated funds. We're only going to talk about self-managed super funds today, of course. So for self-managed super funds, they get a cost-based adjustment. Now, for those of you who were working in super in 2017, you may recall the 2017 cost-based reset that we had at that particular point in time when the transfer balance concept was brought in. Now, this 2026 cost-based adjustment is very different to the 2017 cost-based reset that we had. So I know 2017 was a while ago, but just to refresh your memory, it was an opt-in, but only certain funds were eligible. So you had to have been impacted by the introduction of the transfer balance cap rules or the fact that earnings on TRIZs wouldn't be exempt anymore. Once you opted in, you could pick asset by asset which assets you wanted to reset the cost base of them. And it impacted the fund's actual tax calculations because we were deemed to have sold the asset, bought it back for its bought it back for its market value at 30 June 2017. So it could have had a tax consequence for the particular superannuation fund. As I said, this 2026 thing is different. We're calling it a cost-based adjustment rather than a cost-based reset, just to remind ourselves that it's going to work differently. Again, it's going to be an opt-in, but all superannuation funds will be eligible. All self-managed superannuation funds will be eligible. Even funds where all of the members' superannuation balances are currently less than $3 million. And that's because it might grow, their balances might grow to more than $3 million in the future. So it might be, if they opt in, it might be useful to them in the future if they become into Div 296 territory. If we opt in, then the cost base of all of the assets that fund holds on 30 June 2026 are going to be adjusted to the market value of those assets on 30 June 2026, but it's going to be for Div 296 purposes only. So the fund's actual cost base will remain the same, and we're going to have a special cost base for Div 296 tax purposes only. So just to give you an example of a superannuation fund, if it opts in. So let's say it bought the property in March 2010 for $3 million. Market value on 30 June 2026 is $13 million. So the cost base of the asset for the fund's tax is $3 million and its acquisition date is March 2010. Because we've opted in from the point of view of Div 296 earnings, the cost base becomes $13 million, but our acquisition date is still March 2010. We don't change the acquisition date. So the acquisition date's not reset. The fund's tax calculations haven't changed. But this asset now has two cost bases, one for fund tax and another for Div 296 tax. And Anthony's going to talk us through how BGL is going to help us keep track of those two different cost bases. But if we have a look at an example of, what it means to have two different cost bases, how is this going to benefit the member of this superannuation fund? So let's say we've got an asset that had an original cost of $3 million. Its market value was $13 million at 30 June 2026. And then we sell this asset, a property, for $15 million in 28-29. And this fund's in pension phase, and the actuary has said that 25% of the fund's income is exempt from tax. So from the point of view of the fund's actual tax calculation, we've got sale proceeds of $15 million. We've got our cost base of 3, our original cost base. We're going to take off our 1/3 discount as normal, and we're going to take off our 25% exempt income. So we've got $6 million worth of capital gain that's going to be included in the fund's taxable income as normal. From the point of view of the fund's Div 296 earnings, sale proceeds are still $15 million, but our cost base is $13 million because we opted in. We elected to adjust the cost base for Div 296 purposes to its market value on 30 June 2026. So our gain is in fact only $2 million. We're still entitled to the 1/3 discount, but we don't get that tax exemption for our being in pension phase. So we've effectively got $1.3 million included in Div 296 earnings. So you can see a significant tax benefit for the member of opting in to that cost base adjustment, because whilst the fund's tax calculations haven't changed, from the point of view of the Div 296 earnings, we've got a much lower figure included in earnings because of the fact that we opted in. Now, what if we'd actually sold the asset for a loss? Now, most of the time we make gains. Sometimes we make losses. So if, let's have a look at another example. Original cost base of this asset is $1 million. Market value is $3 million on 30 June 2026, but then we sell it for 2.5. So it's sort of spiked at 30 June 2026, and then it's come off. So again, from the point of view of the fund's actual tax calculations, sale proceeds of $2.5 million, cost base of 1, original cost base, we've made a gain of $1.5 million. For Div 296 earnings purposes though, sales proceeds 2.5, but different cost base, remember. Market value on 30 June 26 is the cost base, which was 3. So conceptually, we've made a capital loss for Div 296 earnings purposes. Now, let's say we don't have any other capital gains or losses for this fund in this particular financial year. Do we carry forward that Div 296 loss? No. We only carry forward capital losses that arise in the fund's tax return. For the fund's tax calculation, this fund made a capital gain. This is just a special Div 296 earnings calculation where we happen to have made a loss. If we don't have any other gains in that year, then effectively we'll just lose it. So we can't use a Div 296 loss in the year of sale. If we can't use that loss in the year of sale because we have no other gains or losses, then we're just going to lose it. So the amount included in Div 296 earnings is just going to be nil for this year. It's not negative $500,000. What if though the fund also sold another asset in that same year and made $1 million gain in respect of that asset? Would that change things? Yes, it would. So from the point of view of the fund's actual tax calculation, the first asset we made a $1.5 million gain. Second asset, we make $1 million gain on that one. So we've got $2.5 million worth of gains in the fund's tax calculation. From the point of view of the Div 296 earnings, the first asset we sold made a loss of 500 grand. Second asset, we make a gain of $1 million. So we're sitting at a gross gain of $500,000. We get to offset that gain and that loss because they happened in the same financial year for Div 296 purposes. So if my Div 296 earnings amount in that particular year will only be $500,000. So if I'm going to realize a loss for Div 296 purposes, then I'll have a think. Are there any other assets I could sell in this fund in this same financial year so I can make use of that loss? Because otherwise I'm just going to lose it. A few other little things on our cost base adjustment. If we opt in, then we're resetting the cost base of all of the fund's assets, all of their CGT assets, of course, to their market value on 30 June 2026. So what if at 30 June 2026, I've got an asset that's actually sitting in a loss position? Its market value is less than what it cost. Opting in is potentially going to result in a higher Div 296 capital gain in the future if this asset becomes good. Now, we don't get to pick and choose. We can't say, oh, well, I will only opt in for the assets in a positive position. It's an all-in type of situation. So, some clients will think about realizing some losses before the 30th of June 26. If they've got an asset they don't expect to recover, for example, they might sell that before the 30th of June 2026. They'll make a capital loss on the asset, which they can then offset against current year capital gains, or because this is a loss for the fund's tax calculation, we'll carry it forward and we'll use that to offset future Div 296 earnings. Just remember though, if you've got a fund that is entirely in pension phase, we call those segregated pension assets, everything's in pension phase, no point doing that. Capital losses on those sorts of assets are completely disregarded, just like we disregard the capital gains on those assets. So we're off to getting the question now was, will the fund's assets have to be revalued at 30 June 2026 if we're going to opt into this cost-based adjustment? Well, look, they will, but we already revalue assets to market value every 30 June. This is no different, really. There's a little bit of extra complexity. It's really about paying closer attention to those tricky to value assets. That might be your properties where we don't have any comparable asset sales. They're in a strange location or they're a bit unique. Private equity, so where we've got super funds that invest in private companies or private unit trusts, those things that are just a little bit more difficult to value, they're going to be a little bit harder as well if we're going to try and work out what the market value on 30 June 26 is, so we can use that as a cost base of the asset for Div 296 purposes. Of course, if we're in that territory, then we want to think about getting our valuations as close as we can to 30 June 2026. It's certainly going to be much, much easier to work out the value of a property effective 30 June 2026 if we're starting to get those valuations around 2026. We don't want to be waiting until, March, May 2027 to be backtracking and finding out what the value of assets were at 30 June 2026. And of course, we're going to have to keep really good records because this is going to be the cost base of this asset for Div 296 purposes. So just finally, if we opt in, the cost base adjustment only applies to the assets owned by the fund or via an LRBA. So if we have, for example, a superannuation fund that owns units in a unit trust and the unit trust owns a property, we're not adjusting the cost base of the property. We're only adjusting the cost base of the units in the unit trust. So that can give us some slightly different outcomes. Check your SMSF accounting. Watch those situations where you might have single line entries. So you might have a client who's got a wrap or an SMA, something like that, and you just record that asset or that portfolio as a single line on the SMSF's financial statements. You may need to split that out for the purposes of opting in to the cost base adjustment. Anthony might give us some tips around that when we come to his section. The opt-in deadline, it's the due date for the 30 June 2027 return for the superannuation fund. So that's usually going to be 15 May 28. Don't lodge 26 late because that's going to mean that your 27 return date becomes earlier. You'd have to be making your decision and making your opt-in earlier. So we want to make sure that whilst we might be behind perhaps on our 25 year ends, we want to make sure that we're lodging our 2026 returns on time. So we've got the maximum date for making that cost base adjustment. Now we don't yet know how we're going to do the cost base opt-in. The legislation requires it to be put in the approved form. We don't yet have details of what that approved form is, but that will all be forthcoming by the time we get there. All right, so I can see that we've had lots of questions coming in. I was gonna break for questions, but Anthony, how about I just hand over to you and I have a look at these various different questions, and I might be able to synthesize, summarize, and we'll cover them right at the end. How does that sound?
Sounds perfect. So I'll
Excellent.
continue with the presentation. Let me share my screen. All right. So what I'm going to go through is what BGL is going to look at in terms of an implementation timeline for Division 296. So we've sort of broken it up into three phases. Phase one is leading up to 30th June. We're looking at more sort of identifying members in those funds that are going to get caught up by this Division 296 tax. Phase two is more focused around the cost-based reset aspect of things. So this is looking at your 27 financial year. And finally, phase three, which is to do with the actual calculations as well as the ATO reporting side of things. Uh, this is just the timeline. I won't be discussing specific dates as such. It's more sort of a pecking order of how we're going to start implementing some of these changes. So starting off with phase one, so the first thing you want to do is try and identify who are those members, what are those funds within the, let's say, your simple fund license. So this you can sort of start doing as of today. So let me quickly switch to simple fund. So you should be able to see my simple fund screen. So for those of you that are BGL clients logged into today's session, the first place you're going to look at is the transfer balance dashboard, which sits under the dashboards menu. Now, the reason for that is, as Lynn alluded to, as part of Division 296, it's looking at your entire superannuation interest. So if, for example, a member has both an SMSF and an industry fund, then you want to make sure you have those industry fund balances recorded within the software as well. And this is where you do that. So within the transfer balance dashboard under the fund view, you've got this add external TSBs. So this is where you go do that. So we've currently updated it for 2025. We'll update that for 2026 when we do release our tax time update in time for you to sort of start collating all that information. The next step is you're going into our Insights dashboard. So that's under the Home menu. You've got your Insights dashboard. And on the left-hand side, you've got these various filters. The one I want to focus your attention to is the total super balance filter. So we've currently updated this as at 30th June 2025. I'm going to select the filter 2.7 to 3 million. What you can then do is you can go update those values as well. So you can customize that as you see fit. I'm just going to go 2.7 and over. And the whole idea here is, as this is as at 30th June 2025, the expectation is that come 30th June 2027, these members would hit that 3 million threshold. So on the right-hand side, essentially what it's doing is it's filtered out all the funds within my BGL license that has a member that fits that profile that I've just filtered for. Let me go into one of the funds. So this Nandes family SMSF, if I go into the contribution section, it'll show me all the members within the fund. But what I want to focus your attention to is this total super balance. So it's going to show me as at 30th June 2025, which members potentially I need to get in contact with now, because potentially they will be hitting that Division 296 tax come 30th June 2027 or in the 27 financial year. So it's all about identifying those members to have those conversations earlier on. Now, if you want to go an extra step and sort of do some forward projections and estimations, we also have on the top right-hand side here the little sort of mustache icon where we have an AI assistant that would forward project based on your 20. So in this particular fund, I've completed 2025. So it'll go and try and forward project for 2 years as to what sort of a Division 296 it's looking to potentially pay for each of these members that are sort of caught up. Um, this will tell you exactly what it'll do, what its assumptions are. And you've got these prompts at the bottom here. So one is to do with the calculation of Division 296. There's one for the cost-based reset as well. Just with the cost-based reset, it's going to use your last, what we call create entries. Uh, It'll use the last market price versus the purchase cost of the asset to tell you whether you've got a gain loss position overall for that fund. So the closer you get to 30th June, and you've done a create entries or a lockup as we call it, it'll be closer or more accurate. It'll obviously be sort of perfect if you do it as at 30th June, but just to sort of give you an idea of whether or not this fund would be looking to sort of reset its cost base. Like you wouldn't do it if you have a massive sort of unrealized loss, but if it's a gain situation, you'd probably want to sort of reset that cost base, assuming you have a member that's going to get caught up by that Division 296. I've done the sort of calculation of sort of this estimation piece. I'm not going to go through the full calc, but just to give you a quick snapshot of what it'll do, it'll go through the full calc. It's all sort of further up. I'm not going to focus on that, but essentially what it'll do is it'll use your 30th June total super balance for each of the members. So John was our problem with 13 million. It'll forward project out to 2027. Then it'll proportion out what percentage is over 3 million, what percentage is over 10 million. It'll use the earnings from 2025 to forward project at a 5% growth rate to 2027, and then look at, okay, what sort of sort of tax it's looking to pay that particular member based on the expected 5% growth. So like I said, just an estimation. If that's something extra you want to sort of do, you could use our AI assistant to sort of navigate through that piece. Okay, let me come back to the slides. So that's what you can do leading up to 30th June. Phase two, as I said, is going to be focused around the cost-based reset side of things. So one thing we want to do is we want to provide sort of a Division 296 report, which will identify each of your assets along with, as at 30th June market price versus the cost, whether you have a gain loss position for each of those assets, and then a final sort of gain loss position as well, just to make that decision making endeavor simpler. So we'll provide that report for you. We also want to give you a cost-based reset minute. So I saw a few questions that had already come through talking about, does a trustee need to sign anything? Look, we're going to provide you the trustee minute so that you can get the trustees to sign off saying, yep, we've decided, whether or not to reset the cost base. And look, you have till the end, sort of, I think it's the lodging of your 2027 tax return to make that decision as well. So we'll provide this to you sometime in the next financial year or by the next financial year. Another big one we want to do is a cost-based reset screen. So as Lynn mentioned, especially if you've got situations where you've got a 1 unit wrap that you've recorded, and and you decide to reset the cost base, instead of you having to then go into your transaction screen and break that particular investment up into the individual underlying assets, we will give you a worksheet of sorts that where you can give us that detail, which we will use just for Division 296 purposes. As part of our CGT register, we will anyway need to maintain two separate cost bases, one just for your basic accounting and tax purposes, and one specifically for Division 296, assuming you opt to reset that cost base at 30th June. So I guess to give you a sort of a worksheet or a separate screen where you can sort of tackle all this. So that's phase two, and then finally is the phase three portion, which is to do with the Division 296 calculation itself. So as you can imagine, our create entries process will need to run sort of two parallel calcs for CGT purposes, one for Division 296 and one as we currently do. And it needs to sort of cater for both the two tiers, your 3 million and 10 million thresholds. And year one has a different logic to any subsequent years because year one or the transitional year does not look at the opening TSB, just the closing TSB. So few sort of changes there. Potentially you need to, assuming you have multiple members in the fund, for member earnings, you need to get an actuary certificate as well. So that has potential changes in terms of the data that we do send to the actuary. We have just started sort of consulting the actuary providers as to what changes potentially they see us having to send through as part of providing that percentage back to us. And yeah, then there's the whole threshold indexation as well. The 3 million gets indexed at 150K, the 10 million at 500K, all tied to CPI. So similar to T-bar, but we want to bake that in as part of sort of implementing all these changes at the beginning so that when those indexations do take place, it's an easier change for us. With the Division 296 tax, the members or the trustees rather can opt to pay it out of the super fund, at which point we need to think about, sort of a release authority minute in terms of super stream and so forth. So all that sort of we need to cater for. And then finally, the reporting side of things. So, speaking to some of the ATO guys, they did refer to a sort of a CGT election form as part of the 2027 tax return. Again, not 100% sure, but we need to be ready for sort of changes of that nature. Also, we want to provide a full reconciliation sort of report of our Division 296 calculation. As you can imagine, certain investment reports as well will need to potentially have new columns there for just the Division 296 side of things. Whole heap of changes in the pipeline, as you can see. So that's essentially our timeline in terms of implementation, the various phases that we're going to sort of attack these requirements. Essentially, that's what I wanted to cover off in terms of BGL's roadmap surrounding Division 296. And this is based off sort of how we've read some of the legislation and the regulations, as well as speaking to clients. If you think of any